Welcome to Real Money Talks, how to make money, manage money, and invest money. Your Real Money Talks host, Laurel Langmeyer, gets straight to the point about what it actually takes to make money and build lasting wealth in today's changing economic climate. If you're ready to get the financial results you've always dreamed of, keep listening. Real Money Talks is the right place for you. And now here's your host, Laurel Langmeyer.
Hi, this is Laurel, and you are at Laurel's Real Money Talks podcast. Welcome back. And today we're going to talk about a variety of just money, currency conversations. You know, Trump has said many times he's going to be increasing our interest rates. We saw, a very, very small jump, really nothing to be affected, given all the other initiatives that he's paying attention to now. My prediction is if we see it, it won't happen until late summer, fall. And I have Weldon Wulstein with me now. He's my CFO, very senior tax strategist, and want his to weigh in on this opinion on what's going to happen when the interest rates go up, what happens to our currency, what happens to gold, and what do you, the consumer, need to be aware of and watch out for. So welcome, Weldon.
Well, thank you. Glad to be here.
So let's just talk about, just Trump in general, right? What do you, I know everybody laughs. So what I love about him is that he's a pure-blooded entrepreneur just like us and a wealth builder. And but he's also, got his hand deeply into Wall Street. So as he mentions raising interest rates, what's your kind of comment or thought on when do you think that's going to happen and what's going to happen?
Well, I think he's got a lot of stuff on his plate, but I do think interest rates are going to go up. They've been artificially low for quite a while. So I think it is going to happen. Exactly when that does happen, it's going to also kind of depend on the strength of our economy and making sure that our economy can handle that increase. And because the housing market is very reliant on that low interest rate. But let's assume that he does increase them, which is, I think you're right in your prediction that they're going to go up. Maybe not a huge dollar amount. Mm-hmm. Maybe over a couple of years, they'll be slowly ticking up. But probably for most of the consumers, the biggest thing and the first thing that they're going to see is a change in their credit card debt. Their credit card interest rates are going to start going up.
And there's not a lot of notice on that. That's just
they'll just get a letter and saying, "Hey, congratulations, we've increased your interest rate on your credit."
Yeah, and thank you for more money.
Yes, exactly. And so, not just the credit cards, but that's because being aware of that when these interest rates do go up, making sure that you are paying attention to your credit card debt, and that's you're not letting it get out of hand. The second thing that a lot of the consumers will see, and it's pretty immediate, is purchasing the car loans or cars. Right now, you can go out and buy a car for 0%, 0.9%. That's a $50,000 loan at a really inexpensive cost.
Yep.
That's going to go away. So those two things happen pretty fast. Then everybody's always concerned about the mortgages, and obviously because it's a big part of our economy. The real estate's a huge part of our economy, and if our mortgage rates go up, we're going to see a slowdown in that. And hopefully it's not a big enough slowdown
in the purchasing of real estate.
Purchasing of the real estate, and investment in this real estate, other things going into the real estate, people even just purchasing their homes. But so they do have to be a little bit careful with that. But kind of my prediction is they'll probably just ink it up a little bit, maybe a quarter point at a time. Mm-hmm. But one of the things a lot of people don't realize is that even if the interest rates don't go up or it's not going up anytime soon, the banks are anticipating it going up.
Yeah.
So they're already slowly increasing those rates. You'll watch that. It may not be a quarter of a point, or may not be a big jump, but maybe it's an eighth of a point, or it's a 16th of a point. Mm-hmm. So they're getting ready for those increases because they're paying attention to the economics and the economy, how strong it is and how strong the market is. They watch inflation, so they're paying attention to all this stuff. But with the mortgages, again, that's where a lot of people will feel it, and that's probably going to get the most publicity because, again, that's probably the biggest sector that is really affected by it.
And is it going to be harder to get mortgages as the interest rates go up?
Well, what happens is because if the interest rate goes up, your payment goes up, qualifying for the mortgage, that you could have to have more of a disposable income to qualify for it. Hopefully it doesn't happen. The way it's supposed to work is the economy is supposed to be strong, so people are making more money. So that gap grows, and then that it just is taken up slowly by the additional interest. But yes, it could make it more difficult for somebody, especially the self-employed people, to get that loan. So, I mean, again, that's where, and a lot of my clients come in and say, well, I want to pay as little tax as possible, but I'm also wanting to refinance my house.
Mm-hmm.
And those two things are very difficult sometimes to coincide.
So explain that. Explain why that's true.
Yeah, what happens is if we want to pay a low tax, we have a low adjusted gross income. So we try to take as many deductions as possible. We, accelerate expenses, but then we get this great, tax return. They maybe pay a, 15% net tax, and then they take it to their mortgage broker or their bank and say, oh yeah, by the way, I want a $500,000 refinance on them, and they just get laughed out of the office because they don't have enough income on that tax return to qualify for that mortgage. They might have cash in the bank, but the mortgage broker or the mortgage company says they don't really care. They want to see, especially after the crash, they now have little check boxes that they've got to tick off. If you have a W-2, check yes. Okay, good. I mean, if they go through this thing, and it's really funny because they really don't pay attention to it. They're just going through and checking out boxes.
Yeah,
it is
just robotic.
It is. I mean, and so that's something that you really have to be aware, and especially if you're. And this is where you have to plan these things. Mm-hmm. I mean, if you're looking to refinance or if you're looking to buy a home or buy another investment property, we need to take that in consideration when you're doing your tax return or when you do your tax return, because they look at the tax return.
Unfortunately.
One of the things, well, yeah, they used to, remember when they didn't even look at it?
Yeah, non-stated income.
Yeah, you could just say, I make $400,000 and show them money in the bank and check, done deal. Well, a lot of people actually didn't make that $400,000.
Yep.
And probably didn't have that much money in the bank.
And the property really wasn't appraised at the level.
No. So there are obviously a lot of issues. Yeah. And so part of this reaction is to stop that and not allow that to happen again. And obviously they went way far over to one direction and made it really difficult for anybody who was maybe self-employed to get it. And we're starting to see that loosen a little bit, but it's really interesting just to see the check boxes. Mm-hmm. I've got a client now that he owns his own company, his 1120S, and his 1120S lost a ton of money, but he's got a giant W-2 because he wanted to refinance. And yes, it's not necessarily the best tax strategy, but he was able to refinance and went through. There's no problems, no questions.
Because of the big W-2.
Because of the big W-2.
Yeah, I know. So that does go hand in hand. So interest rates. First, they'll see it in their credit cards. They'll see it in their vehicles if they decide to purchase them, and then mortgage. What is the interest rate? So just kind of describe for our listener the interest rate and gold balance and how that works out. Because a lot of people are heavily into gold currencies or other currencies, right? Mm-hmm. But they're heavily affected by interest rates.
So it's gold and the value of the dollar and the interest rates, all these things are really kind of intertwined. So if interest rates are low, gold's going to be a better option because one, it's a little less expensive. The fixed investments and bonds, aren't going to be paying back as much. Mm-hmm. You also need to then also consider the value of the dollar and where it is and watching these fluctuations. So if the dollar's strong, the gold price is probably not going to be, or it's probably going to be dropping because there's not as much demand for it. Mm-hmm. Now, if our dollar is strong, which means we then have a higher interest rate, so that's where this interest rate starts to correlate with the currency. And you can watch day to day with the dollar how it's doing against other currencies. That will create whether it creates the demand or a extra supply of the gold back and forth. And so that's really where we're kind of watching it. And then we also, the other things we have to bring in inflation. And so when the inflation comes in, we have obviously with inflation is where the cost of living goes up versus what we're having now. And if we keep our interest rates relatively or artificially low, we're going to see an inflationary period, which is what they're doing right now. And so that's probably honestly the biggest risk I think we have is seeing an inflationary period, like a large inflationary period. And so that's why I think they're going to start increasing those interest rates.
So I got to ask though, although the interest rate was artificially low, would you also then tie that to an artificial seeming growth in the economy. And the reason I say that is because salaries have not really increased. I mean, everybody's fighting for a new minimum wage, but really the income growth isn't keeping up with the inflation growth or any of the other. It's an interesting conversation.
No, I mean, and yeah, same thing. You come back to we've had a record low unemployment rate, but the jobs that are coming into after the unemployment, are they jobs that anybody really wants? They're lower paying income jobs, and so you're struggling probably more because now you're having to work a longer periods to make that money. So yeah, and then if you add the cost of living, if that goes up, then I mean it's even worse worse effect on that. And so yeah, I don't think there's necessarily one answer to solve the whole thing. I mean, what the whole idea of this is, if it piques your interest, pay attention to it. Because I mean, nobody ever paid attention to it. I mean, we had kind of talked about because another idea is Trump's probably going to loosen some of the regulations.
Yep.
So we talked
Frank,
about,
right? Let's talk about that.
Some of these things that they're going to loosen, and whether they completely do away with it or whether they just modify it. If you get rid of the regulation, the stock market and Wall Street's going to probably love it because, one, they're going to make a ton of money.
Well, they're going to create all sorts of creative new products they did in 2005, 6, and 7.
Which it will be also interesting because most of the investors will love it because they're going to start making some giant returns.
Yep.
But there's always one thing that happens is somebody's always going to be holding the bag when it drops. Because making these creative products are great and a good idea, but a lot of times they can be riddled with problems or issues, or maybe not necessarily, they don't have the financial backing.
That's right. Yeah, they don't have the asset back
that really will protect it if something bad does happen, if we see a downturn in the economy. And so, I mean, when you do look at some of these alternative investments, and especially the things that are made into different securities, make sure you understand what you're getting into. Make sure that they have a good financial backing. I mean, for me, it's kind of fun to watch these companies and how they get valued. I mean, they get valued off of something, and you look at their balance sheet and their assets, and they don't even have anything. I mean, they shouldn't be valued at their value, yet their stock prices is going up. I mean, it can be a fun roller coaster to pay attention to, but you really need to pay attention to it.
So, we're all off Wall Street. I mean, that's my whole theme, is off Wall Street wealth and how to create it. So a lot of these are market-driven products. So if you stay out of the market, right, you do real estate, gas and oil franchise, you own, the businesses in your community or, around your country, is that a better place, safer place to stay for those that are listening? Because I'm with you. I think if it doesn't pique your interest, I would say keep your head in the sand, but do not, complain and cry about it when everything goes, because you don't know what you're doing. So the entire, conversation is to you to get in the conversation and learn more. But back to my question, isn't off Wall Street assets, the fees tend to be less, highly disclosive, versus the Wall Street, products.
So one of my things that is really key is you want to know who the team that runs the company is. So are you able to call up Walmart and go to their board meeting?
Right, exactly.
Probably. Well, some people might.
Yeah, some people might.
But probably not. I mean, so you really don't know what's going on in that company. Whereas if you're looking at something that maybe is an alternative, I mean, whether it's a business in your own community or if it's some other franchise of oil and gas, can you call them up and talk to them? Ask them questions. Sit down with them. I mean, these are things. So by doing that, you're creating your due diligence. You're basically going through this list of, okay, well, I've met with them. You ask them questions and ask them. I mean, you should always be able to ask somebody a hard question. And they might not know the answer, but they should be able to get you the information to satisfy your question. If they're not, then it might not be the best place for you to put your money.
Correct.
And I agree. I mean, I'm not a huge fan of the stock market either, because you're trusting an advisor. You're trusting an advisor who probably makes less than you do because they're usually on commissions.
Yep.
But you're trusting them that they've done their research on this, either mutual fund or this stock, that they know this. Which really, to me, doesn't make too much sense.
Well, and let's be honest, Weldon, they mostly, like if you're a Fidelity advisor, you're selling Fidelity products.
Right.
So you went to a 2-hour class to learn about this bond and this fund, and then you're just supposed to sit and, tell anybody who walks through the door that that's the perfect plan because it's their own products. That's so consistent. But it's shocking how many millions and millions and millions and millions and millions, not just Americans, but people just trust that advisor model.
Well, and not just that, but can you talk to the fund manager?
Right.
Can you call them up and say, hey, what are you doing? What stocks are you buying?
And you know that they take all their fees on the front, where Off Wall Street Assets takes it on the back, or with the investor on the depletion times.
So and that's key. I think the stock market is for some people. I've got clients that love it and they pay attention to it and they're looking up stuff and they're researching stuff. But if you don't have that time to research it, you need to come up with your list of what your requirements are, and you have to pay attention to it. Or you have to at least do your research in the beginning, talk to people, meet with them, ask questions.
Well, like we say, be active, right? Passive and active. You can't just park it and pray and then hope it all works out. So in this, changing time of the new administration, I'll go back to interest rates, the gold, just our currency. What advice would you have for someone, in addition to paying attention and starting to learn and get involved in the conversation? What other just straight street advice? What should they be watching for?
So, some of the things right now is if you have any kind of variable mortgage or interest rates, think about fixing them. Look at your credit card debt, make sure that they are, what they can cap out on. That long little booklet that everybody gets that nobody reads. There's some rules in there of what they can do and how much they can raise it. So look at that and know that. So you at least are prepared and you understand what's going on. If you have, again, any kind of interest, I would try to fix it. Looking at now as far as kind of looking at the currency and or like the gold. If you are interested in having a physical asset, watch the market and pay attention to it. And then, there will be from day to day that it fluctuates. And, if we see an increase in the interest rate or whatever, I believe in actually owning physical gold or physical silver between owning just like a fund of it.
Right.
Because I just like to hold it.
Mm-hmm.
It's kind of fun.
Okay.
I do own some of it, but I own it more for it's not a true money-making endeavor for me.
Right.
But
you can't exchange. You can exchange it in gold shops and,
right.
On the market exchange, but you can't go to a restaurant and eat with it.
No. Yeah. That would be kind of funny.
It would be a circle. That's what's interesting too about like the Bitcoin people.
Technically it could, but do you think that? I don't think they would take it.
I don't think they would take it because most of the people that work there wouldn't know what to do with it.
Yeah.
I always say, the only currency I know how to exchange or a commodity like that would be diamonds in South Africa. You can pretty much go anywhere and they'll take those no matter what. Right. But also that's, interesting culture.
That's a whole nother podcast.
That's a whole nother podcast. All right. So thank you for being with us. Those of you that are out there, again, ask any question, challenge our content, go to asklaurel.com, give us your name, phone number, and email, and ask a question and or ask for an appointment. We'd love to support you in learning your conversation, starting your due diligence, and understanding what you have. And those of you that are heavy in the market, we do have an opportunity for you to load your portfolio and just do a scenario of looking at your fees and taxation. And not that you want, we're suggesting you change it, but I think most of you don't know what you're actually paying. So start paying attention and stay tuned with myself and other guests and our content here at Laurel's Real Money Talks, where we're talking about the real stuff that's going on. And say the Trump administration is giving us a lot of good stuff to talk about. So we'll be back. Talk to you soon. Thanks, Weldon.
Sure thing.
Thank you for joining Laurel for this segment of Real Money Talks, how to make money, manage money, and invest money. To continue this new conversation and to find free resources to support your wealth creation, visit asklaurel.com/podcast gifts. That's ASKLORAL.com/podcast gifts. Thanks for listening and join us again soon. New episodes are released every week.